Hello, everybody. This is Jason Wink. Today is Thursday, August 18. It's about 2 o'clock p.m., a couple hours before the markets close. Those who've been watching things unfold today know that today is a rather awful day in the world of the stock market. We have the Dow, I think, down a little over 400 points. The S&P 500 is down close to 40 points. So a pretty big down day. And I just wanted to give an update because I showed this chart the other day. And last time I showed the chart, I kind of drew in this lower level of resistance and then the top level here. Basically, I just wanted to point out that, looks like what happened. I made the comment last video that, it looked like the market was going to try to put in some type of a rally of sorts to stay inside of that wedge. But if it broke out to the downside, that could spell some not good times for stock investors. And it looks like that's what's happening right now. You can kind of see where the S&P 500 is now. It's broken down below the sort of lower level trend line. And what I suspect will happen is that the trading will remain really volatile. Stocks may drop down to around 1100. That's the very long-term sort of horizontal resistance, if you will, in the market. And if that happens to be breached, investors will want to be very, very cautious. In other words, we'll want to definitely look at reducing any exposure to stocks, at least for the time being. The big danger, though, just so it's noted, is that whenever the markets get kind of squirrely like they are right now, and that's maybe putting it lightly, there always seems to be these huge packages of government intervention. And right now, this sell-off is global in nature. Not just our markets are being affected, but markets all over the world are being affected. And so it's not just the possibility that the U.S. will try to intervene into financial markets, but also that global markets will be intervened. So you may see a lot of action in Europe. There may be action in Asia as well. So I think the danger of people getting too scared out of the market right now is that there could be this possibility of outside interference that makes the market have a quick pop of sorts. But from a purely technical standpoint, the market is really broken down, and I think the S&P off its high is down about 22 or 23% this year. And if we look at where it is relative to its all-time high, it's down around 30%, from where its peak was in 2007. So the bull market that was being enjoyed the last 2.5 years is really kind of run its course. And unless the market can get back above 1200 and stay there for more than a few days, really we need to stay there for a few weeks, I think what we'll find is there's a lot of danger to the downside. As it relates to our portfolios, for those who are clients watching this, in a day like today where the market's down, I'm going to go to a different view here. And you kind of see this is what's happening today. Right up in this area right here, you can see that the Dow is, as we speak, down 470 points, so over 4%. The S&P almost 4.5%. Certainly is pretty ugly out there. For those who are our clients, just know that our moderate portfolio, sort of the one that I use as the proxy that is the most common used by our clients, is actually down 1.19% for the day. So we certainly are not 100% immune to this big, huge 4.5% drop that the markets are experiencing. But doing the things I've been mentioning, staying very well balanced and diversified, has made this drop a lot more bearable. Doesn't make it fun, though. I'm totally understanding of that. We'll continue to keep a close eye on this. Again, we may get more conservative here in the next week or two. Certainly, if the market happens to get all the way down to 1100 and breaches that point, I think investors would be wise to really limit the amount of stock or stock investments, any growth investments that they have. And other things too, I just thought I'd bring this up while I have this video going. I've had people mention gold and kind of what's happening there. For those who are clients of ours, they know that we had held gold for quite a long time. But we actually sold our gold about 2 weeks ago. So we enjoyed a really nice run, but we actually sold it when it was trading around $1,670 an ounce. It's gone up another $100 per ounce. So we would have gotten out right around here. And the reason why, just in case anybody's wondering, in our case, why we did that, if you look up here at the top of this particular chart, you'll see there's a number of times where this green sort of wedge happens, and this is an area that we consider to be overbought or oversold. When that happens, the possibility of a snap downward becomes pretty likely. So you can see the last time we were up and quite oversold, gold ended up dropping, right here. You can see it happened again in this area, and gold, of course, hit a peak and then sort of tapered off and dropped a little bit. Again, it was overbought here, and same thing. And so you get the picture. Every time that's happened, gold has had a drop off. As much as I think gold is a smart investment long term, we do try to make sure that we lock in our gains, and if we can, buy back at a lower price. And that's the idea here. You'll see again almost every time that gold has gotten this overbought, meaning so many people are flooding in and buying it, virtually every other time that's happened, there's been a sell-off of some kind. And right now, gold is the most overbought it's been since sort of February, March area, maybe early April of 2006. And when that happened, gold went from, at that time, was trading about 720, 130 thereabouts per ounce. It dropped all the way down to 550. So at that level, that would have been about a 25% decline that happened in a matter of about 2 months. It didn't matter that, of course, the long-term trend was still positive in gold, but in the short run, I don't think anybody wants to take that type of a drop. So that's really what we're guarding against here. I think we'll probably be buying gold again in the future. We just believe that there'll be some type of a correction of sorts from these sort of extreme rally that it's been on, much like the big rally it had back here in early 2006. And when that happens, gold will come down to a price where it makes it a little bit better to buy. Hopefully, again, a price lower than the price that we sold it at. Either way, we're trying to manage the risk here more than anything else. So just a little update for today. That's kind of what's happening in the world of the markets. One last chart I wanted to show. This last one here, this is looking at Treasury bonds. So 20-year Treasury bonds in the United States. I drew some lines on here. I won't go over those today. But the reason I'm bringing this up is that right now, yields, so the interest rate that Treasury bonds are paying is dropped to the lowest I believe it's ever been at in the history of the United States. And what's happening is when more people buy bonds, it drives the yield down. So when you have people buying bonds, prices go up. When prices go up, the interest rate goes down. When people are selling bonds, the price goes down and then the interest rate goes up. So there's sort of a teeter-totter effect there. And the purpose of showing this is that you'll see there's been one other time where bonds have been bought so much to drive the prices up and the yields down, and that was back in December of 2008. Essentially at the pinnacle of the financial crisis, if you will, people were flooding into Treasury bonds as a safe investment because they were going up and the market was crashing. And when that happened, you can again see there's this big, huge rally that happened towards the end of 2008. Bonds got very overbought, and then they came crashing down. And crashing is almost an understatement because bonds, which a lot of people think are very safe, stable investments, especially government bonds, actually had a price decrease of around 25-30%, somewhere in that neighborhood. I think it'd be actually around 30% from late 2008 until sort of mid-2009. So again, this chart looks a little bit like the gold one in that, Treasury bonds have been a good place for people to be invested the last 5 years, but there's plenty of times when they get overbought. In other words, too many people are flooding into the trade, and eventually you get these peaks here in the relative strength. This is that overbought indicator that we're kind of looking at. And whenever that's happened, you can see there's been two kind of more prominent times in the last few years. Both times followed big sell-offs in Treasuries. So I think investors need to be very careful to be looking at bonds right now as sort of a safe alternative. Investors should be very well balanced, but really one of the safest places to be right now is cash. Of course, the downside to cash is it doesn't pay really any interest these days. And as I mentioned earlier, if we look at the stock market, so looking back at the stock market view, the stock market has had a lot of downward momentum here lately. It may be kind of finding a bottom of sorts, and it may snap back up into the 1250 zone, which would be like a 5, 6, 7% correction, especially if there's some type of government interference. So it's a real quandary for investors. Do you bail out to the safety of cash and earn nothing? And the risk there is you get no return, and perhaps the market does put in a short-term rally. Or do you try to go to things like gold or treasury bonds, which have done well but are looking very, very overbought? Or do you stick with its stocks, which, as I said, from a technical standpoint, look like they may have broken through their support levels at the bottom here? And if that's the case, the market could fall pretty substantially. I think the first stop would be around 1100. If it goes through that, I really see it going down another 15% or more. So it's going to sound like a broken record here, but the best play is be very diversified, have a conservative bent, meaning it's okay to have some money in cash, some money in stocks, some money in bonds. Just don't get too heavy in any one area. With that conservative portfolio, you're going to have limited downside. And if we get to these very critical points where it looks like stocks are not in any type of position to recover, then we need to further exit the stocks, be defensive, and then wait for a better time to buy back in. So that's just my update for today. This may be my last one of the week. So if I don't get back online and post another video or series of comments, I certainly will be back in touch early next week with an update over the weekend when we see a little bit more what plays out tomorrow as well as over the weekend. There may be some news out of the Fed or someone who's trying to step in and shore things up. So everybody have a great rest of your day today. Have a good evening and a good weekend, and I'll be in touch soon. Thanks a lot.